Good afternoon and welcome to this week's edition of Halftime Talk. I'm delighted to welcome back to the table Adi Imsirovic, Director, Surrey Clean Energy, Senior Research Fellow at the Oxford Institute for Energy Studies. Adi, welcome.
Thank you, Sean. Good to be here.
Thank you so much for joining us. I'm really delighted to have the opportunity to speak with you this week because obviously it's also the window of time in which your latest book is coming out, and that's something I want to get to and wish you much congratulations and success with that. But it would be remiss of me if I didn't immediately sort of go to the current state of affairs, if you like, in the world today, this week, as this interview obviously points to middle of the trading week. It has been a very volatile period for all financial markets. And I'm wondering, as we're sort of 2 weeks or so into this sort of banking crisis, as it's termed, and its impact on the energy markets, on the oil markets, have sort of knocked us $10 from an $80 to $85 range to a $70, $75 range on Brent. I'm wondering your initial thoughts on that. Will that persist? Have we been permanently knocked out of that 80 plus down to 70 plus?
I hope not. I hope not, simply because I hope for the state of the economy. I generally, as a consumer and living in consuming country, I prefer to see lower energy prices, especially given all the shocks we've had in the last 12 months. We could certainly do with slightly lower prices, and I think current lower oil prices are a good thing, given the overall state of the economy. Only I think yesterday we had some comments by the IMF saying that they're still warning about the impact of the financial issues that we have right now on the overall growth of the economy, and they were expecting the global economy to grow well below sort of last few years' averages. And I think that's the key. Financial markets matter. Financial markets are important. Very often, my colleagues in the market say, well, supply-demand balances doesn't reflect the situation. Well, it does. The flat price is set by the anticipated demand and supply situation in a few months, not necessarily currently. And that's where the futures markets trade, and then we kind of trade off those futures markets, the physical differentials. I think that's something a lot of people in the market forget. So financial markets matter, expectations matter. Now, well, a Monday morning, yeah, it's a very, very timely, I think, to talk about it, because we still very much don't know how this current financial crisis is going to pan out.
I mean, so far it's been rather, I mean, there's been the dramatic headlines, but ultimately this has been a trend. We were expecting the G7 economies to find their way to recession for some time in this calendar year, as we were told all through last year. The China and Asia and India would recover and give, some forecasting really bionic recovery there. The IEA's, an over 2 million barrel a day oil recovery in 2023, with it all sort of anchored in the fourth quarter. I'm wondering, yes, do those paradigms still exist now as we come a few weeks into this banking crisis? They predated it. Do they still exist now?
Well, I think some of them, they do. Even then, actually, I was a little bit skeptical about some of them. So let me explain. China is definitely coming back from COVID. We know what happens when a country or a region comes out of COVID. We've experienced it. We do have this pent-up demand, and we will see growth in demand in China. Question mark is how long it's going to last, because we've also seen it here. Yeah, it's picked up, but then kind of it tails off. It sort of it levels out. China has its own problems. Whatever the Chinese government has a fairly limited tools in terms of how they can stimulate the economy. There's a lot of debt in China. There's still a problem with the housing market. There are lots of issues that they still have to deal with. And just by throwing money at the problem, they know very well they're going to exacerbate those issues. So they will be fairly careful. From the people point of view, In China, as you know very well, the safety net is not necessarily as strong as in developed countries. So when people come, people don't just go out and start shopping when they feel better coming out of COVID. I think the Chinese consumer is showing that they are also very careful about what they're doing, about spending money. So yes, there is a little bit more travel. There's more demand for sure. And India is a different case. I think India is doing extremely well, but in the scope of things, India is still relatively small consumer, relatively.
Well,
So
about
it's
half the
really
size of terms of imports, at least.
absolutely
Of
less than half the size of China. So essentially, India is not going to pull us out of this sort of demand conundrum. It should be China. But again, as I said, China has its own issues. So I think I am a sort of cautiously positive, but I'm not on the side of those who expect some big boom in the second half of this year, simply because, let's face it, there's a lot of supply coming out of the States, out of Brazil, out of Canada, Guyana, and other places. So if you look at the situation, and plus, let's not forget the sort of the big elephant in the room, the Russian situation, with the G7 primarily under Biden administration pressure, imposed this very high price cap. It's basically allowing, in many ways, Russian oil to flow, and it's flowing pretty much as a lot better than we expected in many
I
ways.
mean, in some ways, the banking crisis, with the obviously 2 weeks or so ago with the Silicon Valley Bank sort of being the first domino, and maybe there are still more dominoes to fall, but it's kind of like this year's uh black swan event. Last year we had the invasion of Ukraine. The year or so before, we had obviously the terrible COVID window. uh is this a lot of narrative about this is so this is kind of a fundamental Lehman moment. It's a sort of 2008 9 that despite having survived this COVID lockdown, the world, and major war in Europe, and this, that somehow the analysis is that this is something much more detrimental potentially. Do you see it in any way in that tone?
Well, certainly, even let's just assume that we stop here. There's no more dominoes. Even with that assumption, the current state of affairs in financial markets is going to curb lending. People are going to be more careful when they lend the money out, especially to startups. Higher rates are certainly going to curb borrowing by many people, so that there's going to be no more chasing the high yield through risk. Is going to be de-risking. And we know, I mean, you've run your podcast for years now. Every time it's risk on, risk off, it's a very important factor in the oil markets. So at the moment, I think, and for foreseeable future, we're very likely to have this risk off situation. So for weeks and probably even months, I think we're going to see some pressure on the oil markets, which is going to be fundamental, driven by the fact that it's going to be less lending to sort of new businesses in the marketplace, and therefore is going to curb economic growth overall.
Have we completely forgotten about the war, Russia's invasion of Ukraine? Is that a marginal actor now when it comes to the energy markets? We saw in the last few days the announcement of Russia relocating some tactical nuclear weapons to Belarus, with some signal that they could become an actor in the war.
Well, those are scenarios that we don't really like to think about very much. I mean, the situation is certainly not improving from the security point of view, but these are sort of, we're discussing worst case scenarios. At the moment, on the front, what we have is a stalemate. We have a Chinese proposal, which is very much rewarding the sort of Putin's conquest, therefore not acceptable to the West or Ukraine being most important one. So we don't have a resolution on that side of things. So I don't see the end to this conflict. In terms of how the conflict impacts the oil markets, which is what we are interested here in, is that I think G7 have made sure that Russian oil continues flowing, and in fact, if it wasn't flowing, I think that Joe Biden would be extremely disappointed. because he's very much concerned about prices of oil and gasoline prices. So we see the market usually works, Sean. Market works. We discussed that in London when you were here. You know, there's always people find a way how to make oil move, and Russian oil is moving very, very well. If there is any impediment to that move, it will probably be a real physical impediment in terms of shipping, for example. And we've seen shipping costs go through the roof. We've seen products are struggling, especially gas oil is looking for new markets. But sooner or later, we find the ways where simply Russian oil gets blended in Turkey or somewhere in the Middle East, and then it gets sold as a sort of different gas oil, and markets continue to work.
The markets continue to work, and that's perhaps a good segue into your new book, because there's a certain body of thinking is that we may be running out of road here in terms of markets working, the kicking the can down the road sort of metaphor of the financial markets over the last 30-40 years, in the financialization of everything, the derivatives and all of the architecture of the financial system from sort of the early 1980s to the present, where once upon a time a bank took in $1, it lended $1. Now there's all sorts of magic sauce, and the last 15 years particularly has been the printing of a huge amount of money since the financial crisis. And so the idea, and coming into your latest book, which looks at Brent Crude Oil's journey over that time, the benchmark, as the title of your new book is, Brent Crude Oil: Genesis and Development of the World's Most Important Oil Benchmark. And now we're in a world that this benchmark, in the context of oil, has allowed the world every day to trade at least, is it 100 times multiple of the actual physical supply of oil in derivatives? And with that influence, obviously a lot of sort of immature money, or if you like, fund managers who don't know the markets, pumped a lot of money into trading oil and now are running away from oil because of the local recent turmoil. So I just want to start talking about your book from that context, this moment in time, 40 years into the financialization of everything, and Brent's participation in that. Is that a fair analysis in terms of the journey of Brent?
Well, in terms of journey of Brent, it is. The only thing where I would slightly like to separate what you were saying is the way the banking market works from the way the oil market works. Banking market does work on the base of leverage in terms of lending. The oil market works slightly differently. There's no leverage in terms of, there is leverage in terms of using the benchmarks for pricing other products, but not necessarily leverage in terms of pure trading of those benchmarks. So let me come back to that in a second. I think it all started with basically late 70s when people were a little bit sick and tired of the system that wasn't working. I don't know if you remember UK or Ireland in the 70s. It was a very sad place. There was a lot of strikes. There were high prices, very high inflation. Things are simply not working, and
very high interest rates.
Very, very high interest rates, exactly. Low investment, low productivity. Everyone was talking about, especially in the UK, being a country in perpetual decline. And then came the sort of the Conservative government of Margaret Thatcher, which a figure that's controversial. I'm a big supporter in many ways, at least from the sorry about this.
Please.
I've got the phone trying to kill me. Should have switched it off. And then what we have is a situation where then Ronald Reagan comes in at the same time, and we have liberalization policies and the ideas of Milton Friedman, Hayek, and so on come out and say, look, we have a lot of problems in the economy. We have a lot of obstacles to doing business, a lot of obstacles to investment and productivity. If we just remove those, we will probably see more economic activity and lower prices. And that actually that is what happened. It's undeniable that liberalization of the energy market in the UK and the United States brought about lower prices. It's no coincidence that OPEC gave up their price making around the same time, because the markets basically very, very quickly took over. And that's because the liberalization policies allowed the markets to actually operate and take over. So OPEC said, okay, well, we can't do this anymore. We'll leave this to the market. So it was a good time when electricity prices, generally utility prices in the UK, actually came off, because we had monopolies like British Gas that were not only exploring, producing, distributing gas, but actually selling your appliances. It was a very bizarre situation, and generally, I do believe that governments and states are not very good at running businesses. I think the government should stick to the business of governing and providing for
What
public goods such
in
as health and
terms of
education.
those problems, the origins of the Brent contract, was it? I mean, I don't think it was envisaged that this was going to be the bionic global benchmark. I mean, that wasn't the problem that was looking to be solved at the time, was it? I mean, did it grew into being much more than was initially envisaged?
They're definitely not shown, and that's one of the reasons for this book. I mean, as you know, right now we have situation in the Middle East where we're trying to grow some new markets for Murban, for Upper Zakum, for Oman, in China for a basket of crudes. And the big question mark, something everyone is asking, especially I know every time I go to the Middle East, it's like, why aren't prices set here in the Middle East? That's where the oil is coming from. Well, I think we have to analyze how these markets actually grow, how hence the genesis and development. We need to actually go back to history and say why they grow and why they actually expand, and what are the factors that let them grow and actually become efficient. And that's precisely why this book was written by a number of old hands who were actually in the industry at the early time of the Brent genesis. So I think
Perhaps you could just tell us about one or two of those old hands who are featured in the book. I mean, you've structured the book so that the story, it's like an oral history in a way. It reminds me of when I was reading through the synopsis, it reminded me of a documentary I worked on many years ago for BBC, where we rushed out, this was quite a few years ago, to capture the surviving oral history of stories from the Irish famine, which had been a little bit longer ago, 150 years, but it was a critical window to capture the voices of the stories that had still survived that long. In some ways, you've done a similar kind of, this is as much an oral history as it is an economic history book, in the sense of those who were there capturing their stories. What from those stories stood out for you in terms of sharing with us one or two that tell maybe a bigger story?
Absolutely. I mean, if I may just say, it all started when I wrote my book on the trading and price discovery for crude oils. I interviewed quite a few people, and a lot of these interviews just couldn't fit in the book because of the way it was structured. So I thought, wow, what a great story to go back to. So I went back to a couple of those people. So just to start with the book, the way the book is structured, I kind of introduce the book and I write the first chapter about why we trade benchmarks, how we got to that stage, precisely what we were talking about a minute ago. Then Liz Bosley, who was a trader at British National Oil Company in the old days, basically we're talking about 1970s, wrote a chapter about the first Brent trades, how they came about and how tax spinning came about. So that's kind of in a nutshell. One of the brokers also wrote a piece, Nigel Harris, about the role of brokers in that sort of tax spinning. So it's all part of the same chapter. And then we move on with Colin Bryce, is a very, very well-known Wall Street refiner. He actually started with British National Oil Company as well, and then moved on to work for many years in Morgan Stanley. He was head of commodities at Morgan Stanley. So he writes.
Do you think without Brent, could we have seen the emergence? Would we have seen the emergence of the likes of the major independent trading houses like Vitol and Mercuria and Trafigura? They also were born and raised during that window of time.
Absolutely not. Absolutely not. If they did exist, they would exist in the same way originally the companies like Vitol existed. There were small company trading fuel oil around Rotterdam. That's what it was. So there was still original trading companies started around products, because obviously the market was monopolized by Seven Sisters, and later on OPEC obviously came in to make an attempt to take over from Seven Sisters, which they simply couldn't do because they didn't have the same tools that Seven Sisters had. And that's why I do the introductory chapter, to explain that, how it happened. So then Colin Bryce actually does a great job of actually talking about a number of these companies that are not around anymore, like Transworld and so on, he puts a lot of interesting characters in there as well. So I don't want to sort of spoil the story, but an interesting chapter from that point of view, touches on the role of Sogo Shoshers, or Japanese traders in the Brent market, and moves on to trading companies and so on. After that, I asked, Kurt Chapman, who was global head of crude trading at Mercuria. He writes a chapter which kind of covers most of the Brent period, and he calls it the Brent Legacy. So the legacy of Brent, and he pretty much covers a number of things, from the tax spinning to how the trading companies optimize their books around the tolerance, because the buyer, the end user of the Brent, whoever lifted the Brent, could actually lift 5% more or less Brent. So of course, if you paid a very high price for Brent, you would lift less. If you paid a low price, you would lift more. Now, if you're on the same Brent chain several times, you can make a lot of money just by basically lifting those cargoes, selling them as dated, and cashing in on your tolerance. And then he moves on to explaining. His chapter is probably going to be the hardest one for a general reader, because he's pretty much a trader who talks about arbitraging between EFPs, between futures and cash and storage plays. But it's I think a lot of people who are in the industry will find it fascinating. Then we move on to David Godfrey. David Godfrey was a big figure. Basically, he was head of operations. So the key operations to Brent operations are key, and Brent operations were very different from any other operations of any other crude. He was head of operations BNOC, and then moved on to set up the old ELF trading as in Geneva, which is now Total.
And given the journey and the narratives that all of your authors share about their journey, at any point, and which is currently sort of brings the current journey of recent years, that at Brent started to lose its fit for purpose role. Would that be fair to say? And is there thoughts and insights on that, and how it's been kept relevant?
What we tried in this book is go towards the earliest days as much as possible, because for the same reason that you mentioned early on, when I was doing research for my book, Trading and Price Discovery, I realized, I came across some people who are pivotal, but they wouldn't talk about things, which is something that always happens. And then I found out a lot of people are either unwell or actually not around with us anymore. And
hence why it's such an important oral history book.
Exactly.
I mean, like Ian Taylor, for example, who was not an old man, sadly fell to illness not long ago, but a giant of the journey of the story.
Absolutely, and sort of we didn't want to lose this to the end of time, so I almost kind of panicked and thought, gosh, we've got to do this quickly. Plus, it was a great opportunity, because now we've got this new Brent that includes WTI, essentially starting from June this year, and the book is actually timed to coincide with the launch of the new Brent on the 1st of June this year.
Well, the other interesting thing that sort of intersects with that timing, and that Brent as its journey over the last few decades, and now, as you say, most recently in its reconfiguration to include an American crude in the basket, WTI, and at the same time, we see the American oil majors, Exxon and others, for the first time, strangely enough, starting to build their own trading desks. Is that coincidence?
It's not
WTI into Brent?
It's not a coincidence at all. I'll come to this point. Let me just mention something before I forget,
yeah,
which is very important. this is one of the reasons why it's so important to study history. A lot of people have forgotten that in mid-80s, after 86 price collapse, over 20,000 wells in the United States got shut, and basically the liquidity on WTI contract dried up. So it was then NYMEX that actually introduced the alternative delivery, and they pioneered it. So you could actually deliver Brent, West African, and other sweet crudes into the WTI contract. So originally it was WTI, they introduced Brent into its own contract in the 80s, and it worked really, really well. And if you read that history, you become, well, it's not so odd to include WTI in Brent now when we're running out of liquidity in the North Sea. So it doesn't make sense. Going back to your question, absolutely. Now with energy transition and with energy companies looking for their own sort of role in this new energy transition, trading is one of the obvious roles that the likes of Shell and BP, with their Stasco and BP Oil International being the biggest trading companies in the world, essentially.
They're made fortunes in recent years trading.
Absolutely. We're talking about billions of dollars. They don't publish their trading results separately, but you can sort of, a lot of people have attempted and figured out numbers, but we're talking about billions of dollars. And now that trading power, electricity is becoming a big deal. LNG has been a big story in the last 10 years. So trading the LNGs made them like a lot of money. And the same is the case with the likes of Vitol, Glencore, Trafigura, Mercuria, Gunvor. Record profits have been coming from LNG trading, for example. So they're just using something they're very good at, applying them to all these new markets. And markets are important. I think that's why this is another reason why we wrote this book. But that markets are not omnipotent. They can't solve all the problems, but where they work well, they work really, really well. So one should learn lessons from books like this one, not to sort of mess around, especially at the time now when we are imposing price caps on oil and gas and all sorts of other.
Well, we have once again, and you used the word in your earlier comments there about national economy, which Margaret Thatcher broke apart. We do feel like a lot of it feels at the moment, in the recent years, increasingly the national piece coming really back into the markets, and we saw most recently the government of the United States covering the bank deposits of the Silicon Valley Bank way beyond the legal requirement. The insurance was $250,000. They went to 100% everything. Again, it's just another way in which the national actor, the federal, the sovereign, is intervening into the markets and has been for a decade or more in increasingly pronounced ways. And you wonder, are we really suffering the consequence of that now, because the markets are now distorted by these interventions? Listen, Andy, we're going to have to leave it there. Our half hour is up. Your book, very much looking forward to getting the full and final version in my hands. A summer read, it sounds like.
Can I just mention
for nerds? Yeah.
Can I just mention that David Pennicott, author, also just three more, who was a president of ICE, International Intercontinental Exchange, Adrian Binks, president of Argus, and Neil Fleming, who worked many years in pivotal period at Platts as well. So they're also the authors of this book.
Well, it sounds like that would be a really fun launch reception to attend, with all those characters hopefully gathered in one room. That would be
June the 1st.
A fun day. Well, I'll definitely mark it in your calendar. Send me a note on that. Brent Crude Oil, Genesis and Development of the World's Most Important Oil Benchmark, with Adi Imsirovic as the editor. And Adi himself, of course, as the editor, brings his voice through the whole book, I'm sure. We'll have to wrap it up there. Thank you so much for joining us this week on Halftime Talk.
Thank you for having me, Sean. All the best.